Hello. Wednesday afternoon in Copenhagen. I am in Copenhagen Airport and waiting to fly to Lithuania. And I really wanted to share some views on the Baltic economies, but I guess some other news came in the way. This afternoon, the Turkish Central Bank, in somewhat desperate moves, have hiked its key policy rate by 300 basis points. It's very much resembles the desperation of the Argentine Central Bank. Um, which recently hiked its key policy rate to 40%. What we're seeing here is emerging market central bankers, very much reacting to the pressure their currencies are coming under, and they are moving to tighten monetary policy and to curb the easing or the curb the weakening of their currencies. And we've seen this historically in Turkey. Once a sell-off accelerates, sooner or later the central bank comes in, and so in that sense, it's not totally surprising. However, the market was not priced for this. We had a very significant reaction in the currency market. The lira initially rebounded 5% against the dollar on the rate hike. It should be said there was nearly as much down prior to that on the day, so a lot of volatility in the Turkish markets today. And of course, as the situation had been accelerating. But however, as I've been sharing with you recently, I very much see this not necessarily as only domestically driven. The uncertainty we've seen in emerging markets is very much driven by the rebound in the dollar we have seen since mid-April, the expectation of tighter U.S. monetary policy, a Fed that likely to continue to hike rates, and that is putting pressure on emerging markets, as always is the case when this is happening. And what we're seeing in that sense is not unusual, and really it isn't a major surprise that Turkey is hit. Is always a candidate. Turkey is a the Turkish lira performs very well in periods of a lot of global risk appetite, and in periods where liquidity is withdrawn from the markets and risk is scaled back. The Turkish lira is always taking a beating. Turkish fixed income market, the Turkish stock market is also taking a beating. There's nothing really unusual about that. That being said, obviously the Turkish government, and particularly Turkish President Erdogan, is not doing anything to prop up investor confidence in Turkey. His highly unusual comments regarding monetary policy recently, and that the Turkish Central Bank essentially were not allowed to hike rates, of course, have spurred some of the sell-off, I think. But in general, this is driven by global monetary trends, and so in that sense, what we're seeing is that the global monetary superpower number one, the Federal Reserve, is tightening monetary policy, causing emerging market currencies to weaken, and then emerging market central bankers respond to that by importing the tightening, by hiking their own rates. We're seeing that in Argentina, we're now seeing that in Turkey, we might see that in other countries, and I'm not sure this is over because the Fed certainly will continue to hike rates going forward further. So it's a challenging situation. As I was walking down here trying to find somewhere to sit and talk to you, I reflected on the fact that I think nearly 15 years ago I wrote a research paper called Turkish Delight about the tremendous reform progress that the Erdogan regime did in the early years of the Erdogan rule. A lot of program on fiscal front, liberalization of the economy, opening up, even prospects for EU membership at that time. All that is now long gone. Erdogan increasingly behaves as an authoritarian president. There's been a crackdown on press freedom. Clearly, investors are very concerned about what's happening on the political side, and of course, we have a war in Syria just next door, a war which Turkey has become involved in increasingly, something that is not only increasing the risk of terror attacks and other things in Turkey, but also puts a burden on Turkish public finances. Turkey has received millions of refugees in recent years, and I think a lot of that is in the background of what is happening here. So it's not surprising, given that backdrop, that Turkey is being hit by these things. What I would say is that we're seeing something interesting, because normally in normal emerging market crises we would have pegged exchange rates, and the outflow from the countries would sooner or later caused the central banks of these countries to give up their pegged exchange rates. Turkey does not have a pegged exchange rate. Turkey has a floating lira. Obviously, it's been in a free fall recently, and the central bank doesn't like it. But generally, the central bank is not targeting the exchange rate. And I think one thing that is interesting is that since essentially the beginning of the Syrian civil war, if you go back to 2011-12, essentially the Turkish lira has started a decline from then on. And what is notable is that that decline is not only a nominal decline, because that we could understand and explain by just the relative differences in monetary policy, higher inflation in Turkey, more easy monetary policy. But what we are really seeing is a real depreciation, a very significant real depreciation of the lira since 2011 in Turkey. And obviously, from an economic perspective, one can note that Turkish economy has done remarkably well, growing 6-7% in recent years. And even though some have speculated that the numbers and the books are cooked, I don't really find any evidence from looking at non-government data that there is a substantial slowdown in the Turkish economy. The Turkish economy has been doing quite well and growing rather robustly in recent years. But that is only when we measure it in lira. If you look at Turkish economic performance and measured in foreign currency, as a measure of the purchasing power of the Turkish nation, obviously the country has been in significant decline. And so a lot of the uncertainty, the heightened regime risk, as Robert Hicks has called it, is not reflected necessarily in real GDP growth or nominal GDP growth, at least measured in lira, but it's measured in the continual erosion of the purchasing power of Turks. And that's essentially a long, drawn out negative supply shock. So the response of the Turkish Central Bank today to hike rates, to some extent, is misguided. It can't fight the fact that there is a negative supply shock that is feeding through and continue to feed through, which is due to political uncertainty, geopolitical unrest, uh, and these things you can't do anything about that with monetary policy. So essentially, the Turkish central bank should allow for overshoot on this inflation target. One could just say the problem here is that inflation target has long gone lost all credibility because the Turkish central bank essentially for the past decade has continued to overshoot its target. So it has been continued to respond to this. You can say in the right way, but there is also erosion of credibility, and of course, when there's erosion of credibility, you get you get the kind of sell-off you've seen recently. You get more volatility. So it's tricky for the Turkish central bank. Should it respond to negative supply shocks? And should it get into a war with President Erdogan? I doubt it would ever win such a war. Effectively, the central bank is highly politicized. It's not an independent central bank. It hiked rates today, and I'm sure Erdogan is not pleased with it. But Erdogan do also realize what drove the central bank to do this. There's no doubt, in my view, that Erdogan likely soon will come out and claim that this is the result of foreign speculation, and God knows who he will blame. This is a normal blame game of policymakers who fail. Blame somebody else, and he's right. I doubt he'll figure it out because this is to a very large extent a result of Jerome Powell tightening U.S. monetary policy, or at least moving further in that direction. But there's also a reason that Turkey, Argentina, Poland, Hungary at the moment are singled out by the markets is that they are fragile. They have internal problems, either politically, and most of these are actually political problems. And Turkey do face a lot of these. But I would also say that if you look at the macro situation in Turkey, public finances is fairly sound. The current account situation is not as good as you could have hoped for, and certainly rising oil prices is not helping. That's another contributing factor to the pressure on the Turkish markets. But looking at the Turkish economy, that in itself is not giving me a lot of cause for alarm. But looking at the politics and the long-term prospects for the Turkish economy, I'm getting a lot more worried. And when we're taking that into account and the international environment, it's really no surprise what's happening to the lira. Could it continue? Well, yes and no. I think uh, I doubt the rebound in the lira will be very long lasting, and market participants might test the central bank once again. And there's a limit to how much the central bank wants to tighten monetary policy before at some point that would cause financial distress and a real slowdown in the economy. And President Erdogan would not be happy about that, and that essentially will curb any prospects for rates going to Argentine levels of 40%. So another possibility, of course, to introduce capital restrictions. Turkey has so far, under the rule of Erdogan, avoided doing that, despite his rhetoric. But that might change, and I think for investors that might be a primary concern, is that the risk of capital and currency restrictions. I don't see it happening right now, but one should certainly follow it. But no Turkish delight this time. A lot of headaches in Istanbul and Ankara this night. And now I will fly to Vilnius and to the Baltic states where things look somewhat more delightful.